Well, I think we're going to see the third month in a row with an 8 handle on headline, and we'll see about 6 on the core. I think it's also important to understand that the May year-over-year comparison is 5%. So we had 5% last May year-over-year. Now we're going to have 8%. But I think the market already knows this is likely going to happen. And I think the key question is from here is to what extent do goods prices start to moderate? Because it's most likely, from what we've seen, that the goods component, core goods component, which is about 20% of CPI, has likely topped out on a rate of change basis. So I think yesterday's sell-off probably was in anticipation, and that today, if it's around 8, won't be that much of a surprise.
Hey, Larry, are you in the same category? And if Peter's right, how does the market react? You're always talking to folks on the street.
I think, I think the expectations are very high, right? But, Andrew, you wrote the marquee, Hall of Fame book on the financial crisis. I wrote kind of the backup, second best, maybe. But I think between the two of us, we reached millions of people around the world with our books on the last crisis. And I want to ask you, you lived through 2008. I smell a colossal failure of common sense. The Fed's pushing on inflation. There's no price discovery in the market now for the last 24 months, and now they're bringing forward price discovery. In other words, we're getting price discovery on all kinds of assets, private equity, venture capital. And when you don't allow price discovery for 24 months and then you accelerate price discovery in a short period of time, that is a mess. And the Fed things are moving so fast that economists in the Fed can't really gauge how dangerous the situation is.
So, Larry, you're in the Jamie Dimon Hurricane Superstorm Sandy category? Is that where you are?
Yeah, I mean, when you see Elon and Jamie flip like that, I mean, these are two brilliant guys, and they in like a 2-week period. We run a Bloomberg chat with about 650 institutional investors in 20-plus countries, and there's like a number of people in the conversation that are talking about like the shift in the last couple months in terms of just look at private equity, look at venture capital, look at the tech space, the shift in the jobs. You're seeing a record amount of rescindings. So say you're like a 24-year-old kid, you get a job offer, and then they rescind it. And they're talking about hundreds, maybe 50,000 of these things. And that's the first thing you see before massive job cuts. Bottom line for the audience, by September, we go to negative jobs, and the Fed has to back away.
Peter, Boockvar, those are some fighting words. What do you think?
Well, a soft landing by the Fed is a rare occurrence. And considering the extent of the easing and the greatest extent of tightening that we've seen in 40-plus years, on top of 40-year highs in inflation, it's going to be almost impossible to avoid that. So, yeah, a recession is a likely outcome, but I don't think that's really a profound statement in the context of what I said. I mean, the Fed is between the QT and the rate hikes is a pretty aggressive rate of tightening. And we know that the U.S. economy, created by the Fed, has been on a foundation of easy money.
But Peter, I think the issue is the issue, and I think this is what Larry's saying, and Larry, you can speak to this, that the markets, that this is not baked into the cake in the market. The market does not appreciate this point already. That it has more. Well, it sounds like he's saying there's a much bigger leg to go. Is that? Am I wrong, Larry?
Oh yeah. Well, I think we see 3,200 by Labor Day or somewhere in there. The Fed will then take the 14 rate hike, excuse me. They're promising essentially 14 rate hikes, and with quantitative tightening in there. And I would like to ask Peter, but if they take that from 14 to 7, and the terminal rate is like at 2 to 2.25 versus what what Mr. Bullard, not Bob, but Mr. Bullard's promising 3.5, and all the. So the bottom line is if they stop it in the 2 to 2.5 range, then we get a big rally toward the year end.
Peter, you want to weigh in on that?
Well, he's right. If the Fed just stops there, and the 3,200 is not crazy talk. It's right now the estimates for earnings are about 225, 230 this year, which is completely unrealistic to me. But you clip that by 10%. If we go into recession, you're talking 200. You put a 16 multiple, that's 3,200. So the question is at what pain point does the Fed blink? Is it going to be a lower S&P? Is it going to be a slower economy? Or is it going to be actually inflation that slows? And you can be sure it's most likely going to be the S&P and the economy, and the inflation story will take a backseat to that.